logically, or even if you have to look at it in detail, there is only one question that, one chapter heavily surrounding around the alternate investment, though there are two readings, but one is a bigger one and one is just a couple of study sessions in that. But this is the major one where we look at all types of alternative investments. Just an introduction to various alternative investments. When we talk about the traditional investment world, we were majorly talking on buying and selling. Probably the focus was more on buying and selling, that too exclusively in the stocks and bonds. So probably our equity topic, the equity investments, as well as the fixed income investments. These are the two major areas which deal with the traditional investment world. Even the derivatives on these two, they deal with the traditional investments itself. But apart from these two, there are so many other worlds which have emerged as the investment vehicles. Whether you call it as real estate, which doesn't fall under equity stocks or bonds, or there is something like commodities, or we even talk about some special things also, like probably arts based trading, some special collectibles based tradings. You have various other dimensions, and probably some other things like hedge funds, which have been investing heavily in way across the world, across the various types of entities, and also moving away from this traditional world of buying and then selling. So there is a heavy focus on shorting. Though in traditional equity market, we talk about a bit of shorting, but there are so many rules associated with the shorting and all. But unlimited shortings, and so there is another investment world that has emerged, or probably we even talk a lot about private equity world. We talk about venture capital world, which are slightly more different from the traditional stock and bond form of investing. So these entire things together are classified as your alternate investment space. But of course, in CFA, the major focus is still towards the traditional investment world itself, whereas it is expected that you at least understand the various alternative investments. So that is the reason in level 1, level 2 also they have included some various aspects associated with the alternate investments. Here we have a basic understanding of the various alternative investments, and as you move along, in level 2 we would be typically looking at the valuation aspects also of some of the alternative investments. So yeah, just to summarize that, the various assets which get categorized under alternate investments are your real estates and commodities, some kind of special collectibles, either arts or those kind of stuff, or so probably some specific kind of things also get classified as your alternate investments, and so many variety funds. Fund is nothing but pool of money which is invested for some specific aspect. So something like hedge funds or real estate investment trusts. So it's not a purchase of real estate, but probably it's like a fund which will invest the money in real estate business. So it is like whatever the returns that come on this real estate, they go to these parties. So basically these people are not buying houses, but they are using money to invest in real estate developments and infrastructure projects and blah 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 stuff, where their benefit is only in the form of return on the investments. Right? So like that, there are wide many alternatives that have come out in the alternate investment market. So that is one of the prime reasons studying of finance. See, at the end, when we are talking of a simple finance, it's nothing but if I am investing something today, how much I am getting in the future. That's a typical one-line definition of finance. But because of so many opportunities and so many investment things that are coming out, and the characteristics of each of them in terms of generating this, again from the perspective of risk and return, because these two things differ, what is coming out is wide variety of instruments with wide variety of characteristics. That is what is making the entire financial world more of a complex world. So as far as we see some of the key aspects in alternative investments, we see that they are having very low liquidities. Real estate, probably you can take simple examples, right? Real estate, very difficult to buy and sell, right? Compared to, I mean, if we look at in the current scenario, if I want to immediately dispose my house or dispose my land, not all lands can be disposed so easily. And even if I want to dispose them, obviously I may have to come down on my price. Whereas that's not the case with respect to the stocks. There is a huge liquidity associated with the stock market, with the development of exchanges and all that stuff. So what we generally see is the alternate investment market as a whole also. Let's say I'm talking about a private equity investment. I have invested in a company. I want to pull out of my investment. It's very difficult to find a partner to whom I can sell off my investment part, sell off my stake. So that way the alternate investment market is very less liquid. Not many regulations and disclosures are there for many of the markets. Even today, there is a lot of unorganized market in lot of these alternative investments. You don't see, even today, a lot of real estate is going in an unorganized manner. A lot of commodity transactions happen in an unorganized manner, right? But most of the stock transactions, they happen only on the exchange. And even some of the tools like hedge funds, for these kind of things, there is no solid regulation, there is no regulatory body or something. And here, specialists are very much required, not the traditional guys. That's the reason we talk about high management fees. We'll look at it as we get into the hedge funds understanding. We require a specialist because this is not a traditional market, right? And there's not too much of liquidity in this market. So if at all I have to really evaluate the worthiness of the investment, I need a specialized management mechanism in that. So the fee and all that are being charged compared to a normal mutual fund, the hedge funds charge a very heavy management fees. The reason being, in a mutual fund, there are so many stocks that are available to invest. But for a hedge fund, only some specific investments are being targeted. So identifying that investment is a very tedious job. So and there's a lot of in-depth research that is going on in that space. So from that reason, the management fee and all are very much higher. The specialization is very much required, and probably sometimes what you could see is they offer good diversification benefits. Just as an example, there is always a saying which we might have heard sometime or the other. The stock markets and the gold market are oppositely related. They move in the opposite direction. Need not be the case always, probably, but still you find some level of opposite movement behavior. So which means gold is an part of alternate investments, stock is a traditional. These two are moving in the opposite direction. So if I put 50% of my money in this and put 50% of my money in gold, there is a very little chance that I will lose very heavily. Even in case of a bad market, I am still safe. So they offer very good diversification benefits and they are creating different avenues for investment. So I don't need to buy everything or put my whole money in the stock market in such a way that if it drowns, I will drown. Right? So they offer that potential diversification benefits, and some of these alternate investments, they are helping us to use huge leverage. Hedge funds, they totally depend on leverage, borrowing. Heavy borrowings happen in that space. Even in stocks, we talked about margin buying, where some leverage does exist, but here the volumes are very, very high with respect to the usage of leverage. Then again, some alternative investments like hedge funds, they are very heavily using derivatives in large volumes, whereas a typical mutual fund, right, any of the mutual funds that we have, they cannot use these things, and there are so many restrictions with respect to this. So probably this gives all opportunities in the market open. You invest wherever you want because of very less regulation, and because it's as good as, probably I look at it as specialized service that I am offering to one or two good individuals. Right, for a limited set of people, offering a very high specialized kind of a service. There is a potential for high returns, which sometimes we see in real estate markets. Within no time we can make big money in a real estate market compared to any other market. So you'll see some potentially high returns, but the biggest drawback being the availability of the historical data, because of the unorganization, because of, see, today if I want to know some data regarding probably a real estate property in this area, there is no centralized location from where I can get the whole data, right? So, but whereas if I want how this stock has behaved in the last 5 years or 10 years, I can download the whole data and I can do my own analytics on that. Or probably if I want this company's last 5 years annual reports, I can download it from their website. Whereas here, the accessibility of the data and the historical returns data, even if it is available, it keeps changing quite drastically. So doing some analytics on it is not that easy a task. And measuring the risk is also a very difficult thing. And there are so many unique legal tax considerations that are associated with each of them. So because of, and sometimes everything may not be in white. So because of all these things, the investing in an alternate investment has to be understood completely different from the investment in traditional investment space. So a couple of major are probably where the markets have grown quite better in the alternate investment space. One being the hedge funds. The word itself, hedging, is reduce risk. As an English meaning, hedge is nothing but to reduce your risk. The way they are generally supposed to operate is generate a return more than, probably if I have to put it in simple terms, generate a return more than risk-free rate of return by taking zero risk. The position is very difficult to create. If your risk is zero, obviously your return should be risk-free rate of return. Find an opportunity which can make your risk zero